What if everything you think you know about money, what it is, where it comes from, why it has value is wrong? What if the global financial system isn't a natural evolution of economics, but a deliberately engineered illusion, a design so effective, so subtle, that entire nations built their futures upon it without ever realizing the trap? Because somewhere in the transition from gold to paper, from paper to digits, and from digits to debt, something critical changed. Money stopped being a tool. It became a weapon. Today's story isn't about a single country or a single bank. It's about the blueprint quietly installed over centuries that turned paper into power, and debt into the most profitable product on earth. And the strangest part, the people who built the system are long gone, yet the machinery they created continues running with cold, mathematical precision. The question isn't how we got here. It's why no one noticed. To understand the modern financial world, we have to rewind to the moment money first detached from real value. For thousands of years, money was simple, a piece of metal with a specific weight, something scarce that you could actually hold. Gold and silver didn't need a governance promise. They were the promise. Civilizations rose and fell depending on who controlled the metals. But around the 1600s, a new idea appeared. Paper receipts for gold stored in vaults. At first, it was an honest system. It was safer than carrying heavy coins and much easier to trade. But once people started trusting the paper more than the metal it represented, bankers quietly realized something. They could issue more receipts than the gold they actually held. And as long as everyone didn't ask for their gold back at the same time, no one would know. This was the spark that would ignite the entire modern financial world. A spark born not from government policy, but from simple temptation. This practice became known as fractional reserve banking, the original magic trick that created money out of thin air, centuries before computers even existed. But this wasn't the full-blown scam yet. This was just the prototype. By the 19th century, governments understood the power of paper money. Wars were expensive, and the supply of precious metals was limited. So, nations quietly partnered with banks to issue more notes, backed not by gold, but by promises, taxes, and future growth. Whenever a crisis hit, a market panic, a recession, or a banking collapse, governments and banks responded the same way. Print more paper, extend more credit, expand the illusion. Each crisis demanded a bigger fix, and each fix created a bigger bubble for the future. And somewhere along the way, the unthinkable happened. Gold no longer controlled money. Money started controlling gold. In 1913, the US Federal Reserve was created not as a typical government agency, but as a unique hybrid entity with private influence at its core. Its official job was to stabilize the system by managing the supply of money. But in practice, it concentrated immense power over every dollar in circulation. Other nations followed suit, creating a global network of central banks all connected, coordinated, and increasingly dependent on one another. The old world ran on gold. The new world ran on promises. And promises, unlike gold, are infinitely expandable. Then came the moment that changed everything. The year was 1971. The United States had printed far too many dollars to honor the promise of redeeming them for gold. Foreign nations, sensing this instability, began demanding physical gold in exchange for their US dollars gold. The US simply didn't have. So, in a televised address to the nation, President Nixon announced that the US dollar would no longer be convertible to gold. In one single moment, the entire global financial system was severed from the physical world. Money became a pure idea. Its value was no longer defined by a tangible asset, but by trust, by belief, and by government decree. This wasn't the end of the story. This was its true beginning. Because without gold, without scarcity, without any physical limits, money could expand forever. And if money could expand forever, so could debt. The incentive to print was now limitless. The incentive to borrow was irresistible. And the incentive to question any of it almost vanished. The system rewarded compliance and punished curiosity. And because everyone from consumers and corporations to entire governments was now hooked on expanding credit, no one wanted to pull back the curtain and expose the illusion. After 1971, global debt didn't just rise, it exploded. If you look at the charts from that period, they look less like lines and more like rocket liftoff trajectories. Government debt, corporate debt, household debt, of it started rising faster than populations, productivity, or real wealth. Once money was detached from reality, debt became the raw material of the economy. More debt meant more spending. More spending meant a higher GDP. And a higher GDP often meant more political stability. Debt was no longer seen as a burden. It became a business model. Banks loved it. Governments relied on it. And most people barely questioned it. But the fundamental flaw in the system was predictable. If nearly every dollar is created as debt, then the world must stay in debt forever to keep the system going. And to avoid a collapse, the system requires more new debt each year than the year before. It's like a global treadmill with no off switch. The fallout was inevitable. Wealth inequality widened. Massive economic bubbles formed. Currencies lost their purchasing power over time. And financial crises hit again and again, each one requiring larger and larger bailouts and interventions than the last. The triggers were always different, but the root cause was the same. The system requires infinite growth, but it exists on a finite planet. For decades, economists and policymakers have proposed fixes, tighter regulations, interest rate adjustments, calls for fiscal discipline. But every fix seems to fail for the same reason. You cannot stabilize a system that is built on the foundation of exponential expansion. If central banks raise interest rates too high to fight inflation, they risk triggering a recession. If they lower rates to stimulate the economy, they create new bubbles. Government stimulus programs might buy some time, but they just inflate the underlying problem. Every solution is really just a delay. And every delay makes the eventual correction even bigger. The problem isn't a glitch in the system, it's the design itself. The architects who created the early banking systems could never have imagined a digital world capable of creating trillions of dollars with a keystroke. But the logic they built, fractional reserves, credit creation, compounding interest, scaled perfectly into our modern age. We don't just live in a monetary system, we live inside a monetary machine. And that machine has no brakes. Most people think today's economy is more sophisticated than in the past. In reality, it's the same basic scheme, just running faster and on a much grander scale. Think about it. Over 90% of the world's money is now digital, created by private banks whenever they issue a loan. Total global debt recently surpassed $300 trillion, a figure that's hard to even comprehend. The majority of national currencies have lost between 90 to 99% of their purchasing power since the gold standard ended in 1971. And the reserves that banks hold often represent just a tiny fraction of total deposits. Meaning our money only truly exists as long as we all believe it does, and no one panics. We've seen this movie before many times throughout history. Ancient empires would dilute their currency to fund expansion. Medieval kingdoms would shave metal off coins to cover their deficits. And modern nations devalue their currencies through inflation. Different tools, same pattern, and ultimately, the same consequences. Every one of these cycles ends the same way. When enough people realize the money is unreal, the system resets. So, what are the key takeaways? First, the global financial system didn't evolve naturally. It was engineered over centuries by a series of incentives that prioritized power and expansion over long-term stability. Second, modern money is no longer tied to reality. Its value depends entirely on our collective belief and the system's need for constant debt expansion. And third, every financial crisis reveals the same truth. The system isn't necessarily broken. It's working exactly as it was designed. Not for the average person using it. And here's the warning. Systems built on illusions always face a reckoning when that belief begins to fade. The only unknown is the exact moment when people finally realize the paper or the digits on the screen hold no power on their own. If you want more deep dives into hidden financial history, the mechanics of global debt, and the systems shaping our economic future, subscribe to the channel. Hit the notification bell and share this video with someone who still thinks money is simple, because understanding the illusion is the first step to navigating it. Thanks for watching.